sort of decline are we expecting to see in house prices? Because at the beginning of the year, it started off quite strongly, but it has been tapering off, hasn't it?
Yes, year-on-year growth in the third quarter was still 7%, but when one got to quarter-on-quarter, that was already in negative territory. Worse on the sectional title side than the freehold, the full title side. That seems to be holding up a little better. Stephen, as we go towards 2011, I think by about the end of the year, we'll have round about 0% year-on-year growth, so we'll probably break even with last December in price levels. For 2011 as a whole, I expect the average price to go down. I've put in 2.5%, which would mean that on a monthly basis, it would probably reach its worst rate of decline by about the middle of next year, say about 5%. And this has a lot to do with, well, there's been a slowing economic growth rate and signs of slowing demand as a result, a lack of interest rate stimulus since last August, and we start off a very fragile platform. It is an oversupplied market. It has been an oversupplied market even through this little mini recovery that we had earlier this year. So it's very easy in such an unbalanced market to get back to house price deflation.
Why do you think we have this oversupply? Do you think it's because more units are being built that just aren't being taken up? Or do you think people are perhaps selling houses and renting or perhaps leaving the country?
I don't think the immigration rate at the moment is too bad. It was in 2008 at one point. It's more about financial stress. We see in our estate agent survey, they estimate about 25% of people who are selling in order to downscale due to financial pressure. It's not an exact science, but the numbers are quite high. So that helps to sustain an oversupplied market. And then, of course, as is normal, when you get such a big boom as you did a few years ago, and with a lag, quite a big building boom, there was, I think, a significant oversupply of new stock coming to the market too, although that part has dried up quite significantly.
Do you think going into the recession, our house prices were a bit inflated?
Yes, look, it's a very subjective thing. If, hypothetically, we had an economy still growing at 5% per year, those inflated prices would possibly be fine and we wouldn't have to see deflation. But it's more about supply relative to demand, and the supply has continued. It hasn't moved much, but it's the demand that gave way during the recession of 2008, which was an abnormally extreme recession. A lot of household balance sheets got hammered, and now, of course, the household sector has to rebuild that balance sheet. So it delays a lot of its spending, such as property. It has to often replace a vehicle that's aging, or it has to just do basic maintenance on housing or whatever. Getting to the stage where it sells to upgrade and all those more sort of non-essential things, that's some way down the track for a lot of people. First, they've got to rebuild their balance sheet after the knock they took in the recession.
I mean, you said economic growth has tapered off as the years progress, but it is still positive. What sort of growth figure do we need to sustain property prices where they are and to perhaps grow them?
I would say gut feel is right now one would have to go back to something like 4 or 5% economic growth quite quickly to avoid or to stop deflation in prices. Unfortunately, at this stage, it's not looking like getting there anytime soon, not only through any doing of our own, but obviously we are a globally driven economy, and that part of the equation doesn't look particularly good.
How about new home buyers coming onto the market? Does it look like they're not coming on? They can't afford perhaps the deposits, because we know banks have become quite stringent with deposits for houses.
That is, banks have unintentionally exposed a big weakness in this economy, and that's a lack of savings. The Reserve Bank's figures for the second quarter still net to savings of minus 0.2% of disposable income. And so, yes, and I think that's worse on the younger side of the market. So as soon as banks reimpose any form of deposit, that lack of savings it becomes a problem. So yes, the average age has been rising in recent years of home buyers. First-time buyers haven't been as strong as a few years ago. And yeah, that's an important source of demand which is lacking at the moment.
Of course, previously it was possible to get a 110% loan on a property if you wanted to buy one, so that deposit wasn't a problem, was it?
No, it wasn't in the boom years.
Some of the banks, though, are still offering 100% deposits for first-time home buyers. You don't think that's encouraging buyers into the market?
Well, I think the first-time buyers as a percentage of total buyers have increased since 2-3 years ago during the recession where they reached rock bottom, and a lot of that has to do with some relaxation of credit criteria. But 100% loans, I think, are still in the minority for the industry as a whole. It's still a stricter environment than 5 or 6 years ago. So yes, first-time buyers have come to the party a bit more in the last year or so, but it's still lacking compared to what it was a while back.
You also point out there's a slight disparity between sectional title markets and the full title market. Why do you think we're seeing that?
Well, I think the sectional title market was a big target of first-time buyers back in the boom years, and of buy-to-let buyers, sort of investment buyers. And so big demand surge earlier in the boom years, and as a result, with a lag, a big supply surge too of new stock coming to the market. And so that in more recent years has been a relatively oversupplied market. The full title market is driven very much by the 3-bedroom market, which is more established family demand, and that's a more stable form of demand. It's not as cyclical. And I think that stood the full title market in better stead during these weaker times.
How about the buy-to-let market? Do you think rentals are strong enough at this stage to support those buying second properties as an investment?
Well, it's there are some, when you go to the repo auctions and so on, you're getting discount prices or from stressed sellers. There are some investors that can get the yields they want. But a few years ago, people would buy rental properties even at low yields, and they would sink their own money into paying the shortfalls on the bond until such time as rentals had inflated, rental income had inflated a few years later. But now it's a financially stretched household sector, so if the rental isn't covering the whole bond, it's less attractive for a certain group of people.
Of course, there are suggestions we could have another interest rate cut as early as next month or perhaps early next year. Do you think that would help the markets substantially?
Every bit helps, Stephen. My concern obviously is if we get to abnormally low levels of interest rates, somewhere along the line we might have to hike abnormally to get back to normal. So be careful what you wish for. But every little bit of interest rate cutting in the short term does help. But the slow rate that the SARB has been hiking at does mean a lack of stimulus compared to a year ago. Up until August, we had a rapid-fire set of interest rate cuts, 5 percentage points, and that was a sizable stimulus. And now the positive effect from those rate cuts is wearing thin. What's replaced it is a much slower pace of rate cutting. So there's actually a lack of stimulus compared to then, even though rates are still coming down.
Do you think now would be a good time to fix interest rates if you're a home buyer, or if you have an existing mortgage? Because if we're not at the bottom, we're pretty close to the bottom of the cycle.
Well, I never like to say to people they should or shouldn't fix rates. It depends on their risk appetites. But generally, I think you get your better fixed rates when rates are still going down, when they're near to the bottom of the cycle and the market's still expecting further rate cuts. That's where you can get your possibly your best
which would be now then,
fixed
really.
rates. Yeah, so if you do like fixed rates, one should probably not wait until rates are actually going up, because by then all the forward rates in the and things to which these fixed rates are linked are all pointing up because the market expectations is up, and then you tend to get less attractive fixed rates. So it's everybody's personal choice, but if one does like fixing rates now in the low and declining rate times, are probably not a bad time to start looking.